You know, I know that.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
What a week since last Thursday.
Roller coaster, they call it. Roller coaster. Wow. Buckle up, people. Buckle up.
Yeah, so, I mean, all we were talking about last week was how the yield was creeping up. I think it's in the last 6 months, it's gone from 2.05 on the 10-year yield. Now it's at like 2.85. And finally, you know, we have a new Fed chairman coming in, and we have, you know, fears of inflation, and then boom, you know, the stock market does what it does. It's in its correction mode, and I don't know, what's it, 10% down since last Thursday, last show we had. So it's kind of crazy. So we're going to talk a little bit about that. Definitely interest rates are up. It's something that they say 4-year highs, but depending on where you are, it could be a jumbo. Remember, 4 years ago, jumbos were really high. And if you're back in a jumbo, you probably are lower than where you were 4 years ago. So your credit score may have gotten better. Your equity probably got better. So there's a lot of different reasons why your rate may not be at a 4-year high. Maybe it's at a 1-year high. We remember at the beginning of the year, we had what was it, Gordon, about April or May, that we had rates that were like 4.3, 4.4. That's pretty much where they are right now, according to the Freddie Mac Weekly Survey. So depending on where you are with your scenario, something that we talked about last week is how to get low rates or continue to get the best rates. How about that? Continue to get the best rates is credit. So always keep an eye on your credit. 50% of the people walking around have no idea what their credit is, which still blows me away. And it's not just like, oh, I pay my credit cards on time, my mortgage or my car payment. It's maybe somebody got involved in your credit that you didn't know about. And then if you go to a transaction of any kind, and then you just find out that somebody's been screwing around with your credit.
Well, you know, credit is a snapshot of time. I tell people all the time. You can actually have good credit today and bad credit tomorrow. I mean, there's a lot of activity that happens out in the marketplace. There's negative things that go on your credit. There's something that you didn't pay maybe 2 months ago, and it now catches up to the report. So there's a lot of things that happen on your credit report. That's why it's very, very important to keep paying attention to it, because as we talk many times on the show, everything is credit driven. The better your credit score, the less everything is going to be at a cost to you. So we got to keep that in mind.
So you can call the show, 800-516-1220, 800-516-1220. Just go ahead and get right into the big story, stock market reaction to interest rates and yields. There's fears of inflation, the fears of the Fed raising interest rates 3 times this year, and the 10-year yield over the last 180 days seen a 40% increase. This is what a correction looks like after what we would call some good times. We've had low rates and a booming stock market. Usually we see a booming stock market, a little bit of inflation and slightly higher rates. So this is kind of a wake-up call. It's a catch-up. William Dudley is the president of the Fed's New York Regional Bank. Thursday, he called the stock market's decline so far small potatoes relative to the outsized gains that we've seen over the past few years. If it stops here, the implications for the economic outlook are very marginal. If we were to go much further and be much more persistent, then it could start affecting household and business spending behavior, and that could actually start to influence the economic outlook. We're not quite there yet. It comes in cycles, Gordon. We were just talking off air about like some buys into some local internet companies and, how we can, kind of manage our own finances on our end. But it's all about cycles, right?
Everything is cyclical. I tell people all the time, we had a great bull run. Interest rates been low for 7 years. Of course, if rates have been low for 7 years, they must go up. The economy works on change. It doesn't work on stagnation. So if the market goes up and goes down, it's a healthy market. As long as you don't see the real high peaks and low valleys, it's important. The market's going to continue to rise. Some days it's going to go up and some days it's going to go down. But when we're bullish on things, or we are things for the long run, I think the overall long-term picture, people don't panic because the stock market went down 1,000 points and then start billing the stocks they already own. It's a healthy market. We've got a great economy. All the economic indicators are the positive. So I always tell people it's not a matter of even writing it out. It's just part of the game plan if you're in the business of watching the stock market go up and down.
Rates and yields are driving much of the market reactions. What's actually happened is investors want more return for their investment based on possible higher inflation. And that's the big elephant in the room. One analyst at mortgagenewsdaily.com, his name is Matthew Graham. I watch him quite a bit. In fact, if you want to watch rates and kind of get mortgage news and all that stuff, and a lot of good data is mortgagenewsdaily.com. He explained it this way. So, Gordon, you give me $100. I'm going to pay you $110 over the next year. That's a 10% return. But if the item that I want to buy increases to $140, instead of that $10 profit, I'm actually going to lose $30 if inflation were completely out of control. So this kind of illustrates the bond yields are generally higher than inflation because of the absence of like artificial boosts like the Fed buying. Investors won't make money if yields were lower than inflation. As a result, yields have risen and mortgage rates along with them. Right now, the 30-year fixed, according to Freddie Mac Weekly Survey, at 4.32%, up from last week. 15-year at 3.77%, and the 5-year ARM at 3.57%. We expect to see these rates continue on a higher path, with the 10-year yield eventually hitting 3%. A lot of people are talking about it's about 2.85 right now.
Well, as we talk on previous shows, if you go back in calendars to 12 months, 24 months, even for all the Fed increases over the last 2 years, I think we had 6 increases over the last 2 years, we are still probably within 0.25% of where we were over the last 2 years as far as rates concerned. So once again, no need to panic. Everything is going to go up. Your credit card payments are going to go up. Your adjustable rate mortgages are going to go up. We just have to kind of hedge and kind of plan for this thing because it's part of the economic plan as far as the economy is concerned.
Kind of reminds me to make sure people aren't overreacting. And you are going. In fact, we heard a commercial right before the show started about stocks. If you're worried about your stocks or your portfolio going down, call us. A lot of people are going to be saying that about interest rates, especially if you're in an ARM or you're in an equity line. You hear the Fed say they can raise interest rates 3 times this year. Then you watch the indexes go up as well. And maybe you have an ARM and maybe you have an equity line or both. And that scares people that their payment can go up based on something that's happening in the economy as opposed to having a 30-year fix. And you can hear a lot of people talk about in commercials, and they're going to pop up. We're not going to do one. We're going to talk about how to protect yourself, obviously, but definitely look at the scenarios if you're in an ARM. But I would start looking at that. And if you've got some equity there and you want to buy like the rate down, which a lot of people do, and fix it in, it's still not too late. And again, I'm not trying to scare you into it, but you should at least look at the scenario. Gordon, you know plenty of people that have ARMs that have been hanging on to them for years because the index has been so low, and they're already they've been adjusting for years, but now they're watching that creep up. What are you telling your clients?
Well, I tell people once again, like everything else, you have to have your finger on the trigger. You have to keep an eye on the economic pulse. What's good today might not necessarily be good tomorrow. But if you watch the arms are going to adjust because those are the first things that you see. It all depends on what your long-term goal is, how long you plan on staying in the property. You have to factor in a lot of economic items or life decisions before you say, well, I'm going to bail out of this arm and try to get into a fixed rate. If you're going to get out, stay in the property another 2 years, the costs associated with getting a long-term fixed rate might not balance itself out. So we always tell people to sit down with your financial planner, let's sit down, talk to us, and we can direct you and give you our professional opinion what you should do, even though the market's in a topsy-turvy, very volatile situation.
One thing I think is going to start happening, Gordon, is people are going to start looking at ARMs again. The 5-year, the 7-year ARM. Right now, the 2 and the 10 are really what's driving those yields up, but the 5 and the 7 still look pretty good, under 4%, even in the jumbo territory. Another way that you can get or achieve those lower rates and fix it in for a period of time and maybe ride out that cyclical increase that we're going to see.
Yeah, and what typically happens is, we always talk about the mentality of the borrower, of the client, of the stockholder. When rates are going down, classic. People call, we do marketing. We said, hey, now it's time to refinance into a lower rate. They always say, well, I'm going to wait. It's going to go lower. And now we're seeing rates start to creep up. Now you see people bombard into a rush to try to get their application in because they're afraid the rates are going to go higher than anticipated. So it's always, the yin, the yang, I guess I call it, as far as economics is concerned, people and their finances.
So mortgage activity increased slightly during the week ending February 1st. The Mortgage Bankers Association says its market composite index, a measure of application volume, rose a modest 0.7% on a seasonally adjusted basis. There you go. Activity's been strong since the beginning of the year, even though rates are going up. And this could be one of the reasons. Getting out of an ARM can be a very strategic hedge against those higher rates, or fixing into another arm for 5, 7, or 10 years, which I call it managing your mortgage, Gordon. I've been saying this for years. I don't know why I haven't patented that or copyrighted that saying, but
manage your mortgage.
Manage your mortgage.
Well, let's find it. Once we get off air, let's go online and check it to see if manage mortgage is available.
Don't take it.
If it's available, we're going to jump on it. Even though you're giving the secret to 1,000 people are listening to us.
couple things that I think are going to you got to run the math here. You look at something like the Bay Area, and as a first-time home buyer or a repeat buyer, median home price in the Bay Area Peninsula could easily be 1.2. East Bay, I don't know, 880, I think is what I saw. Alameda and Contra Costa County, Santa Clara County, 1.2. Let's just say the median price is about 950. 20% down is a $760,000 loan. Let's say your rate a month ago was 4%. Let's say today it's 4.5%. Just an example. That's a payment jump on a $760,000 loan of $223 a month, or $2,676 a year. You have to make about $6,200 more a year to qualify for that. To mimic the 4% rate, as if you had it, you had to put another $44,000 down in order to do that. To qualify for a median home price in the Bay Area with that new rate, you're looking at about $150,000 a year and the $190,000. So we are seeing some differences in affordability. We are going to see that creep up as rates creep up, and housing affordability in 2017 actually turned out to be pretty good, Gordon, even though we started out about the same as where we ended. This is according to the Wells Fargo Housing Opportunity Index and the National Association of Home Builders. Overall, 59.6% of new and existing homes sold between the beginning of October and the end of December were affordable to families earning the U.S. median income of $68,000. This is slightly up from the 58.3 in the third quarter, and up from the 2016 number as well. So we're seeing affordability remain flat, even though we've seen home prices continue going up and rates kind of creeping up as well. That kind of shows you that the people are, maybe it's the people who are buying. We're just seeing the people who can afford to buy. But you look at the Bay Area, only 6.3% of the people in the Bay Area were able to afford the property that they bought.
Well, a couple of things you said. This is where the market kind of self-corrects itself. What you start to see as rates start to go up, and like you said, the affordability factors start to change, then you start to see what we call DOM, days of the market, on properties stay on the internet, on the webs for a longer period of time. Then you start to see those prices begin to kind of inch down to kind of balance themselves out. It's kind of for balancing that. Well, I just saw an article here where we find that a lot of people from the Bay Area, when you say the Bay Area, meaning the major metropolitan cities, are beginning to bail to the city's outline, and Sacramento's been booming because of affordable housing. So everything kind of balances itself off. I think we're very resilient when it comes to different opportunities, and that's what we see here in our Bay Area, because we have such a diverse economy and people working out of their homes. That's where things can actually really balance itself off.
So again, this is the Real Estate Report. I'm Tony Mendez. That's Gordon Hines. We're going to ask a couple questions when we come back. How does this affect your marketplace? That is higher rates. Will higher rates have an effect on home prices, and so on? So we're going to continue pounding this topic. We'll come back after this break.
This is Money 2.0 on AM 1220 KDOW.
Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always visit our website, BayAreaLoanSource.com. You can call the show, 800-516-1220, 800-516-1220, or shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Rates are up. A lot of people are freaking out, watching the stock market go up and down, more down than up. And, a lot of people are going to start thinking about how does this affect, your marketplace? How's the higher rates going to affect your home prices, if at all? The down stock market, is that going to change the way people think about real estate? I think in the Bay Area it will. These are really good questions to answer. Personally, I do see some changes for the Bay Area. I see higher home prices, and Gordon, you can argue with me if you want. I think we're going to see more inventory in the higher home prices, because I think a lot of these people are like, there's not as many people with, that are going to be able to afford this as there used to be. So we might see those prices fall or stall. Plus, there's some tax incentives that they lost in those higher mortgages. Mid to upper mid levels will stay competitive. And I want to say mid to upper mid levels or mid to upper mid, is somewhere in the, I don't know, I want to say 600 to 900 range, maybe up to $1 million, and then anything below that. And they're going to stay competitive. And that is going to be probably the most desirable price range and stay very, very competitive and continue driving those prices higher in that lower range. Are you going to argue with me on this?
Oh, of course. You know, if you look at the stock market, they say only 20% of the population is actually vested in the stock market. The majority of the average person vested in the marketplace is in a 401k. So the stock market really is not going to have that big of an effect on the general overall consensus of the majority of population because they're just not involved in it. They're involved in it on a secondary sector, meaning just a 401k. And everybody has been seeing their 401k rises, but if you're not taking the money out or cashing out, it's not really a substantial benefit. So I don't see, I think, like we talked before, I see there has to be something major to happen in the marketplace that's going to affect our real estate valuations.
All right, valuations, but will it change the way people think about it? The confidence levels. I mean, you can read any report that came out of 2015, 16, 17, all the way till a week ago, and confidence is at all-time highs right now.
Well, confidence is an all-time high, but if there's a sector that's only affecting 20% of the population, it's not going to make that big of a change. That's the point I'm making. Overall, confidence is good. If you look at when people are confident, they start spending money. They get out of their comfort zone. They buy the car that they've been wanting to buy. They have the house remodeled. They go on vacations that they had always wanted to do because there's a lot of economic certainty in the marketplace as far as they're concerned, especially with the president lowering the tax plan that went into effect 2018, more disposable income, companies paying bonuses, higher pay salaries. That all makes a confidence booster to the people that spend money.
Okay. On the flip side, we are going to see some sort of sentiment fall a little bit, in my opinion. I think that we are going to have people kind of hold back a little bit. We already had, we have at any point in time, we have multiple buyers looking, running around looking at homes. And I think we're going to see some people pull back. I think we're going to see about 25% pull back on that. Although here's the kicker. Here's why I agree with you on the home valuations. There's just not enough homes on the market. And it comes down to, and you said this last week, where are people going to move? If you sell, where are you going to move? Well, one of the things we are seeing are people moving out of the Bay Area. We're working with a couple right now that moved out they retired last year, and they sold their property and moved to Colorado Springs. And they are living off of a small pension, but they have a nice, decent mortgage where they pulled some equity out of that house and bought a new house, and they're living on this pension. Would they have been able to do it here? Maybe not. Would they have been able to rebuy here, maybe buy smaller or buy somewhere a little bit, with more room? Who knows? That's the question I think a lot of people have to ask. Is there room to keep stepping up?
I think a lot of those things sound great in theory, but if you look at, I think they say the average person live within a 5-mile radius of where they grew up. We as people, that's the reason why bad neighborhoods are populated. Why would anybody want to live in a bad neighborhood? People live in bad neighborhoods because of friends and family live around the corner, close by, down the block. So we have that nucleus of that kibbutz type system built into us. So we tend to want to retire and want to move out the area.
Kibbutz?
Kibbutz. They want to move out the area, but they typically don't because of the relationships that they have.
I spent some time on a kibbutz once, many, many years ago, in the 80s. Yeah, it was awful.
Israel, probably?
I was in Israel, yeah. I'm not Jewish, but my dad was stationed there. And spent a whole week on a kibbutz picking almonds. And all I remember was the mud. And I had about 6 inches of mud on the bottom of my feet, and my feet were extremely heavy. It was awful. With that said, you call the show 800-516-1220, 800-516-1220. You can get any of your comments on the air. I love this topic of what we think is going to happen with property values and the people's the way they think about real estate in the Bay Area when these rates change. And we've been talking about this for a long time, Gordon. And like I said, I think these are very good questions to ponder. Again, you can email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We're going to get back to an email when we come back from this break. And then we also want to talk and remind people of tax time is right around the corner and some of the things to look out for if you have a transaction coming up. There's some very important things to double check and make sure you don't do on your taxes for 2017. We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today.
Every Thursday we're here, 6 to 7, the drive time hour. We're beginning to see the clock change already. I'm happy to see it's getting darker and darker later. So who knows, by the next couple of weeks, it's going to be full bright and we'll be on full airtime on the show.
Sunglasses when we walk out. You can always email the show, Tony@BayAreaLoanSource.com. We do have tax time coming up. We're going to hit that in just a minute. A lot of people who are self-employed or have some sort of side business that they write their, they want some write-offs. You got to be really careful if you have a transaction coming up that involves, supplying your tax returns. We want to make sure we hit that real quick. Rates are definitely the big elephant in the room. They are going up. The stock market's really volatile right now. What to do is the mindset of people who are looking to buy, who already own. Are they thinking about selling? I think this is going to be an interesting time to play out some of those scenarios as these rates start going up. And they are looking like they're trending up again for the remainder of this week and possibly even next week. We don't really know where it's going to end up, but a lot of people are projecting that the 10-year yield will end up at 3. It's going to be a long time since we've seen it at 3, and that'll put rates at 4-year, 5-year highs. Again, it's not freak anybody out, but 4.32% is where it sits today. That's still almost 2% lower than the historical average. It's about what we were in April of this year, maybe March. I had to look that up. But 2013, I think, is where we saw the lowest, and before that, we were back in the 4s too. So we've had a really long, good run with interest rates. I wouldn't freak out, but definitely it's something that we're going to continue watching, especially if you're a buyer. That small little increase in rate, a half a point in rate, is about 12% or 6% increase? I can't remember.
Well, going back to the psychology of people, we tend to get spoiled. I think we got spoiled with lower rates for 7 straight years. And as I mentioned earlier, what does go down must go up. And it's not time to hit the panic button. But I think what volatility does, I must admit, it makes people react. It makes people,
it's the catalyst,
what they say, get off the pot, right? And that's what we're seeing right now. People are starting to make changes. People start to make decisions. There are people out there that are contemplating selling their home. Of course, they're waiting for home price to continue to go higher and higher and higher. There was a client that we just did a pre-approval for last week. He made an offer on the property. I spoke to the realtor this morning. The realtor said that they took the property off the market because they thought it was worth more money. So there you have it. So people are always looking for the higher number, the higher edge, and this volatility kind of brings about change. It makes them do something.
Tony@BayAreaLoanSource.com is the email, or Gordon@BayAreaLoanSource.com. This email comes from Charles in Burlingame. I'm self-employed and I need to refinance. I write everything off on my taxes. What is a bank statement loan, Gordon?
Well, it's not good that you write off everything your taxes. You pay low taxes, but you're going to pay a higher interest premium over the time because you're not going to get those really low rates that Tony's just been talking about. The bank statement program is one of the great programs that we have. It's an alternative program to what we call the old stated loan. It's a program that we qualify you on a 12-month or 24-month average of your total deposits made into your bank statement. If you're using personal statements, we give you 100% of the deposits. If you're using business statements, we give you 50% of deposits. So what that means is we take 12 months of your bank statements. We tally up all your total deposits. We minus any transfers or any account, variations between two accounts. We look strictly for deposits. We add those up, divide that by 12. If that number comes out to $8,100, that is the income that we give you as an income to qualify you for a loan. That's the bank statement program.
This is definitely one of those kinds of loans. When I look at it, where you need an exit strategy. It's not the rates, yes, is going to be higher. Not as much higher as you think it is, but it's going to be higher than if you were able to do what they call a full documentation loan where you actually use your tax returns. And an exit strategy is something that you can say, okay, I can handle this higher rate for 1 year, 2 years, 3 years. It could be an ARM, most likely an ARM. Maybe it's a 5-year ARM, and you can handle it for 5 years. But and that gives you time to fix your scenario so that you can refinance it down the road or sell the property.
Well, we always talk about exit strategy, especially when we talk in the private loan arena. You must have an exit strategy because a lot of those loans are short-term loans, 1 to 2 years. So you got to have an exit strategy. What am I going to do? How am I going to get out of that process?
Thanks for the email. You can always email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We'll come right back after this break. We have plenty more to talk about here on AM 1220 KDOW. This is the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Let's kind of hard not to talk about what's been happening in the stock market over the last week since last Thursday, our show. Stock market's down 10%. Interest rates are up. That's a lot of articles out there. Is the decade long trend of downward interest rates finally over? And there's a big picture of Macaulay Culkin screaming. I mean, these are some crazy times when this happens. It freaks a lot of people out because it's been 9 years since we've really seen anything like this.
Well, I think the last crash goes back to 1987. I would just listen to something the other day on CNBC that was just comparing if the market goes down 2, 3, 4% compared to Black Monday back in, I think, October 1987. The market actually dropped 22%. So we're talking 3, 4, 5% drop. We're not even close to anything like that type of catastrophic event. But needless to say, people start getting nervous anytime we move outside of our comfort zone. And that's what happens. So it makes us do things. It makes us act, react. And that's what we're trying to avoid. We're trying to say, listen, everything goes up, goes down. There's always going to be volatility. Volatility is actually good because we can't continue on a pace upward, because we're bound to crash. So if we have some changes and some lowering of the market, the indexes, the same thing, rates going up and down, it's a healthy market, and that's what I'm in favor of.
Definitely overshadow some of the other news that's out there. Home price appreciation is still strong, but slowing near the end of 2017. There was a tight December as far as credit standards, but those are loosening as well. You know, that's an interesting story that we talked about loosening standards over and over, but FHA is showing, Gordon, that the delinquency rate is starting to increase significantly for FHA, first-time home buyers that used FHA loans because of these loose standards. Do you think we're going to continue seeing that type of theme with these loose standards, especially when it comes to, we just talked about a bank statement loan, or maybe it's an income for assets or assets for income loan, and things like that? Do you think we're going to see any kind of fallout from that?
Well, I think in a healthy market, by the way, always going to be delinquency in the loan business, period. You cannot avoid it. Massive neglect delinquencies is what you can avoid. But once again, I mean, we go through lots of changes verifying income. Like, for example, we verify income on an application probably 6 or 7 times. But at the end of the day, if that client loses their job or becomes somehow mentally or physically incapacitated and they cannot make that payment, that loan is going to be on a delinquency list. Now, delinquency does not necessarily mean foreclosure. Delinquency is people that we have rolling 30s, running 30 days late, 45 days late, 60 days late. Now, of course, as that delinquency gets to be 90 days late, that's when you see those notice of default start to get filed. But as far as the market's concerned, there's always going to be a healthy amount of delinquencies built into a profitable market. More than
10% of FHA borrowers this year have had a credit score below 620, compared to only 2% in 2014. 51% of FHA buyers had a debt-to-income ratio of more than 43%. That's up 8% from 2014. So those are the looser standards. So when we talk about credit accessibility, those are the looser standards we're talking about, and this is kind of what we end up getting.
Well, the scoring models has also changed also, so you always got to make sure you qualify what we're saying. So if you go back through the scoring models of FICA, Experian, and TransUnion, over the last couple of years, the scoring models have actually changed. So, of course, if the scoring model change, they become more and more tighter on the model, you're going to see a drop in credit score across the board.
You can always call the show 800-516-1220, 800-516-1220. Email the show, Tony@BayAreaLoanSource.com. We talked about how home price appreciation is still strong, but it's slowed near the end of the year. CoreLogic Home Price Index finished up for 2017, a little bit lower than when they started, but they were up from the previous quarter in the year before in 2016. So 2017 turned out to be a pretty nominal year. What do you think of 2018 is going to turn out? We started out strong, and then, boom, interest rates.
Well, we got a lot of things. I think one of the biggest things that had really fueled the philosophy or the psychology of the borrower has been tax reform. I think once tax reform settles in, I think we just had a new Fed chair change, If you go back through history, we tend anytime once again there's change, there's uncertain, people tend to things start to change. Or if you go back through when Alan Greenspan came in, Bernanke came in, we also see change across the marketplace for no reason other than change. A new person, a change in the guard, new person in charge. So I'm hoping that these are the reflections of it. I think the earlier it happens off, the better we are. I think the most successful part of our years are coming. The spring buying season is around the corner. We want to have a healthy spring buying season, so we want to get these kind of deflations or these kind of volatility out the way so we can move into a healthy spring market, which is going to lead to more and more houses being sold through the summer.
Tax time is right around the corner. And every year we talk a little bit about what to do and what not to do. One of the biggest mistakes we see people doing on their tax returns, especially on their Schedule E, is when they own a property with another person and they only report half of the income and then half of the expenses. In reality, what the lender does is they look at the rents that you qualify for, or I'm sorry, that you reported, but they use the full liability, the full mortgage payment, the full taxes, the full insurance, and all the full maintenance and everything like that. So if that happens, and let's say you break even, to the lender, it looks like you are getting only 50% of that income. Gordon, what is the thing they can do to fix that?
Well, if you look at the best way to do it, of course, is, and we run across the situation many, many times, always, both parties should always claim full income and full expense, and then do the division at the latter part of the return. It's always a better way.
Right at the bottom, they just put times 50%.
Yeah, because the problem is if it's a $2,000 rent and you put down you're only making $1,000 in rent, and it's going to work against you because we won't half the payment. We give you full liability of the entire payment because you're responsible for the entire payment regardless. So it's it's a strategy. Talk to your professional, talk to your accountant, and that's what these guys do, and that's what we all refer back to the professional.
The other thing that we see people do is on their Schedule C income, they're also doing a lot of write-offs. And if you're going back in the day, you could do a stated income loan for somebody who is self-employed. But today, we don't have stated income, so they use, and I don't know why they still penalize people who are self-employed. You can be a W-2 employee, you can use your gross income, but you cannot use the gross income on a Schedule C employee. And because of that, you have to be really careful about what you write off. So if you're looking at a transaction, some of these tax returns, depending on the transaction you're doing, carries for over 2 years. So talk to your accountant and then talk to your mortgage professional before you start doing these write-offs when these tax time comes. It's only a month or two away.
Yeah,
and
we're in a full start.
Yeah.
Every W-2 has to be out by January 31st, and IRS has started receiving tax returns for 2017.
So you can shoot us an email with any of your scenarios, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We'll come back right after this break here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us. You can call the show 800-516-1220. Did I say 12 Tony?
You said 1220. You might have been thinking Tony.
800-516-12 Tony.
1220.
You can email the show Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. So I think we kind of played out the whole, we're in higher interest rates. You can always email us if you have any questions or you want any kind of quotes. We don't give quotes on the air. That's kind of crazy.
Because we like to tailor and give specific answers for specific problems, right? If a person calls, and that's why we get some of the emails. People like to email us and ask us different questions, and we like to share some of those emails that we have that's relevant over the year to other parties. So we encourage emails to come in. We can answer them privately. We can give you a call, and we've been doing that over the last couple of years. It's been a very successful protocol for us.
I like this little article that came out. It's the best city to live in every state, the median household income and projected job growth. Great little report. In the West, like Mercer Island, Washington, 128,000 median income. Beaverton, Oregon, 58,000. Sparks, Nevada, let's just say Reno, 54,000. Monterey Park down in, that's in the LA area. Meridian, Idaho. Orem, I have a friend that lives in Orem. Interesting. Orem, Utah. Paradise Valley, Arizona. What's interesting about this article is that we're seeing a lot of people, and this is kind of aimed towards millennials and why they're moving to these cities, because there's job growth. You look at this report right here, Sparks Nevada is showing a 10 to 15% jobs growth, projected job growth in that city. And we're going to see people move more and more into these smaller cities. Some of the highlights of that: Reston, Virginia, that's going to boom. I really do think Amazon's going to move to Virginia or Raleigh, North Carolina. What do you think? Or Atlanta, one or the other.
Well, I'm betting on New Jersey or Philadelphia, especially since the Eagles just
Man,
won the Super Bowl.
It's a mess up there, though.
Philadelphia is even higher on my radar right now.
It's a mess up there. You have to ask a millennial: do they really want to live there, or do they want to live in a really nice community out east of Fairfax County and in the Washington D.C. area, or Atlanta, where you can buy a house for $200,000? It's a 5-bedroom house on 5 acres. I think that's what you kind of have to ask. And that's why people are moving to these places. For $50,000 income, you can buy a decent house in these cities.
Well, if that's the case, Arkansas should be grossly overpopulated. So people don't want to move to those places. People want quality of life. They want the overall quality of picture, different things to do, different places to see. Opportunity is what people look for, and that's the reason why the cities are so popular. It's why people migrate to the cities. They don't have to worry about transportation costs. You can get around, especially right now. People get on their bikes. You get around public transportation. You go to those outlying cities, you need to have a car. Everything needs to be travel, and that's where those things becomes less and less desirable.
I think there's still quite a few opportunities for investors in the Bay Area and in California, places like Sacramento and some of the outlying areas. We've seen a big boom. 2017 was fantastic for Sacramento. You saw a $100,000 house go to 150. You saw a $200,000 house go to 300. You saw a $100,000 house that goes to $150,000 rent for $2,000 a month.
We saw one of the worst markets in the Stockton area, that place called Mountain House. Houses went from 500 down to 100. Now they're back up to 500,000 again. It's incredible appreciation, or bounce back, I should say. What a place to be.
So if you have any questions or concerns, you can always email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We are happy to be here. We love running scenarios. This is what we do. Gordon's been in the business for 25 years plus. I've been in financing for about 17 years. This is what we do. You're welcome to call the show again, 800-516-1220, or email the show, Tony@BayAreaLoanSource.com. We'll see what happens in the next...
we'll be back next week to tell you.
7 days. You'll hear it from us. We'll see you next week. Thanks for joining us.